my esteemed colleagues. Dan Egan from Betterment, Claire Beams from Rhinevest, who's a Betterment advisor user, and Jennifer Mitton from Interactive Advisors. Thank you all for being with us today, and we're going to talk about robo-advisors, friend or foe. So the first question I had today, and feel free to, chat in some questions if you'd like, and I'll try to incorporate them into what we're going to talk about. But I thought we'll just dive right in. Hey, Jen, so Vanguard and Fidelity report something like 10% of their clients actually use their robo. Schwab's up at 13%. There's been some studies that show as much as 8% are being used by advisors. Do you think that traditional advisors need to be concerned about the competition from kind of the digital advice providers, or are they generally serving kind of two different markets on that?
Yeah, so I would say they definitely need to be concerned. I think because the way technology is rapidly advancing these days, we're coming up with more and more, goal tracking services, such as being able to, people can online plan for school and retirement and saving for a house. And that's all part of robo-advising. And just because of the low fees and easy access, we have also low minimums, $100 minimums now. So I think in order for them to keep up with the, competition, they need to, start being more competitive with pricing and that sort of thing. So, yeah.
So I think this feeds right into a question I have for Claire, which is, Claire uses Betterment for advisors, and so Betterment for advisors is kind of like a white label product. So there's a situation where an advisor is incorporating kind of robo technology to kind of compete in that place. And, how does Betterment for advisors compete, directly kind of with the B2C offering that they have? And what are the pricing differences and how much does it cost, et cetera? If you could just get a little bit into that, Claire.
So I am a financial advisor. I work for Rhinevest, and at Rhinevest, we use Betterment for advisors, like you mentioned, as part of our platform. The clients who come to me are looking for a live advisor, right? They come to Claire Beams because I am sitting in Cincinnati, Ohio, and they were referred to me by a friend or by someone who already works for me, or they live down the street, right? They're looking for a live advisor. So we actually don't compete really or lose clients to those that are looking for a robo solution specifically. So the cost differences, Dan, you might be able to speak more towards the Betterment offering, but for us, we charge 80 basis points and a monthly financial planning fee of $65 a month.
And what does Betterment for advisors charge the end client? Do they charge that on top, or that's included in your fee of 80?
It's included. Yep, it's included with 80 basis points.
I see. And Dan, how much is Betterment for advisors Betterment just their retail offering product?
So it's funny. We often get labeled as fintech, and we're probably a lot more tech than fin. The key thing being that we're using technology to do things. And in some case, that's directly to the consumer, where you're going to have rebalancing and tax loss harvesting. And it's the exact same thing for an advisor. Be it the advisor or the end client, we're trying to unlock their time from being, caught up in minutia, from repeatable tasks that computers are pretty good at, so that they can spend more time thinking about what they want out of their life, more complicated planning, dealing with values and issues that come up. So generally speaking, we don't see there being any competition whatsoever. As Claire said, people who want a live advisor and want somebody to have a relationship with on an ongoing basis, they will pay more for that and they will get more out of it. So it's a win-win. Sure.
So what does it cost directly, though, to go to Betterment for Betterment as a client, as a retail client?
25 basis points either way. There is no sort of disparate pricing. If you're a client one way, you get charged exactly the same as another way.
I see. Okay, great. And Dan, why you're kind of live on the screen right now. So a question that I mentioned before that I wanted to discuss was kind of value and growth a little bit in kind of the robo-advising space. As we've done the Robo Report, we found almost no advisors of overweight growth the last 4 or 5 years, and clearly that was a better area to be in. And I was wondering if you could touch a little bit on why you think that is and how you see that going. Like Morgan Stanley they have like a specific growth portfolio, which isn't widely used. But, all the big guys, including yourself, Schwab, Fidelity, Vanguard, et cetera, generally either have a neutral or value tilt. Being here in behavioral finance, I figure you could answer this.
Yeah, I think there's kind of two parts to the question, maybe even three. One is that purely from a sort of like empirical point of view, when you look back in history, values had a premium to it. And so evidence-based advisors are probably going to look to overweight things that have done well. They'll get caught out occasionally. We know that these things go in cycles and they underperform and overperform on different horizons. Another element, though, that I think is important is getting away from the idea of the portfolio as something that the advisor gives to all of their clients as a one-size-fits-all cookie cutter type thing. We at Betterment offer at least 5 different portfolios, including socially responsible options, income portfolios, even areas where the client can go in and change the allocations themselves to fit whatever they like. So we're getting to the point where there isn't really a Betterment portfolio to be looking at performance of. Much like you'd say sort of what's the best performing car, it really depends on what you're looking to get out of it and your circumstances. We're moving towards a world both from us and with the advisors that we work with, where everybody has a different portfolio that reflects the specific needs that they have based on taxation and planning and circumstances.
Okay, so let's shift gears a little bit, Claire. If I could come back to you. So, we have giant tech companies like Amazon and Google. There's been rumors out there that they may get into the advice or robo advice or digital advice business. If so, what do you think the format's going to look like? Do you think it's going to happen? What are your thoughts there?
I wish I had a crystal ball and I wish I knew if it would happen. I'm not sure. And the short answer is that if they do enter the marketplace, it will change things and hopefully rise all ships that are playing around in this space.
Yeah, for sure. I think it'll rise all ships. I think maybe there'll be some challenges on pricing, but maybe not. They definitely could acquire one, right? Like you could definitely see them like acquiring a SoFi or something like that. Definitely even a Betterment maybe, right? I think that, them converging, and competing against the big Vanguards and Schwabs of the world is a bit inevitable. It seems like they're driving down paths that are going to intersect at some point. I don't think it's going to happen too soon, though. That's for sure. So, there's many people that offer live advice options in their robos, for sure. Hybrid services. Vanguard kind of pioneered it, and they went kind of the other direction and, offered just the robo-only piece later. Schwab did kind of the more traditional approach, getting into the industry with the robo-only and then offering kind of live advice. When the call volumes spike and investors are able to reach advisors during the day, do you think that this calms down, the people? Dan, you're in behavioral finance, so I'm going to pick on you for this one.
A lot of things I'd say it depends. I think that it is very important to speak to the people who are nervous and who are looking for some sort of reassurance, and to do it in a way that understands where they are coming from, having just come through an election. You can very clearly see that people's anxieties might fall in line with what party they support. And you would have to speak to different clients differently based upon what anxieties they were feeling at different points on election night or election week, as the case may be. So that's for the people who actually are anxious and who are following things. I think we tend to, especially if you're an advisor and you interact specifically with those clients, you overestimate how prevalent that is. And what we tend to see is that somewhere on the order of 80% of people aren't paying attention to their portfolios, don't log in, don't want to know about this stuff. Politics especially isn't influencing it. And so you actually don't want to be the one forcing that issue upon them. If they are blissfully ignorant and they're doing well with their saving and their financial plans, let them be. So I think that a bit of sophistication about communication strategies that lets you do targeted reassurance is the way forward. And
hey, Jen, at Interactive, what kind of situations did you see, like in the March timeframe, when people wanted to, bail out of the market, the world was going to end? Fidelity had a statistic out there that something like 25% of the people north of the age of 65 in self-directed accounts actually went to cash during that time. And people, this was kind of the big test, right? Robos aren't going to do well during a market pandemic or such thing as that. And here we got one, and they came out fine. But did you see many redemptions, things like that happen at Interactive? Did you feel like you guys were talking people off the ledge?
Yeah, so I actually started in March, like right before the pandemic hit. So I'm not really, I don't know if I can speak on that one, but
okay.
I feel like there must have been a lot of redemptions during that time, because I could see clients kind of freaking out and thinking the economy's tanking. But yeah, I had literally just.
Hey, Dan, do you want to jump in there and just give me an idea of what you guys saw at Betterment, just to continue that conversation piece?
I'd say it's similar. So what I generally look at is, things like how many clients, what percentage of clients are logging in, and is it unusual for them? Because there are some people who log in almost every day, no matter what's going on. What we generally saw is common for kind of any kind of a market disruption. So we saw the vast majority of people doing nothing. There were some unusual logins from people who usually stay away, usually after the fact rather than before it. There was a little bit of sort of emotional hedging ahead of time. Again, like we're talking about, we see more activity during tax time than we saw during the past 2 weeks, just to sort of calibrate it. So it's elevated, but nothing that, this is not some sort of like huge movement. And again, half of people were actually happy with the outcome, maybe a little bit more given our client base. Combine that with what happened with Pfizer's vaccine news, and generally speaking, it was a very brief interlude of a little bit of anxiety. But I've been with Betterment for 8 years now. I've seen multiple drawdowns of more than 10%, some more than 20%. The people who choose at least Betterment, I can't speak for anybody else, they are not panickers. They are people who understand the investment philosophy. They've chosen it in no small part because they understand what we are going to do for them. So if anything, I'd say that it's a match made the correct way, that we are doing what our clients expect from us, and they are behaving in a way that works very well with our systems.
Hey, Claire, I was wondering if you could touch on, where you see advisors really adding value. Obviously, robo-advisors today have a hybrid approach, many of them, so they can talk to live advisors. But where do you see that, that one-on-one relationship that you have with clients is just different than what they could possibly have at a robo firm? If you could touch on that for a minute or two.
Absolutely. For live financial advisors, our value proposition is that you can come to an office and speak directly with a human being, right? I think that's our number one value proposition, especially that provides a lot of peace of mind for many of our clients. Though I do have clients across the world that I've never met in person before. So I think that second tier of value proposition comes into that holistic financial planning that right now we have an edge on robo-advisors right now. Robo-advisors are catching up, especially with that holistic financial planning and their value offering for clients. And so I think this is when financial advisors are taking down to that third level, which is life planning. And how do I help my clients take a step towards conceptualizing or feeling more joy out of their life through the use of the money that they receive or are investing for the future?
So Jen, what kind of clients do you feel like you get as like your typical client at Interactive these days? Vanguard's been quoted as saying that their average client in their robo is in the hundreds of thousands of dollars. They have many $1 million clients. And then you have, some like Acorn who concentrates on, rounding up the dollar, and, the minimums are extremely low at $100. But at Interactive, what is your kind of target market and niche, and where do you think that you guys play the best?
Yeah, so I would say we're focused towards everyone, and we honestly get a variety of different clients coming in. I think we do tend to get a wider variety just from all different backgrounds and experiences, especially because of like the $100 minimums and the lower management fees. So it allows like investors of all different experiences and ages to join. And we do tend to get some younger and lower asset investors. But it is kind of like a comprehensive solution. So we're offered towards like various different wealth brackets. We're targeting everyone. So we have several different portfolios, including like third-party managers, which have more active stock picking portfolios. So those are for the more experienced investors, as well as like IRAs for people planning to retire. And then we have lower risk portfolios, including like dividend and income for lower risk clients. So yeah.
So kind of one of my beefs in the industry, and really for the whole advisor industry in general, is no one really publishes performance, right? There's no real ways to kind of compare advisors, robos, etc. You know, I like to say that unfortunately, and I'm in the industry, right? I run an RIA, manage $1.2 billion besides running back-end benchmarking. And I always like to say that, you know, if I was going to buy a dishwasher or a washing machine, I could find out more information than I could about an advisor. And I don't think that that's good. You know, these are extremely important decisions, much more important than buying a dishwasher or a washing machine. And so, Claire, why do you think that is? Why do, like, I have a track record, I have it audited, I don't publish it on my website, so I'm probably just as guilty as all of us. But, you know, why don't we do this? Why don't we offer these comparisons?
Good question. And I think part of it for us specifically is that we never want to put projections into our clients' hands that might be misleading, right? So the past 10 years, I was invested 100% in the S&P 500, but who knows how the next 10 years are going to fare for our clients. That was just an example. I actually don't recommend that. Instead, recommend the diverse portfolio. But then I think secondly, one of the things that is hard for us is that because of regulation, we can't show clients testimonials, right? So we have a lot of really good feedback from clients about our financial planning services and how it's affected their lives. But those are things that we can't publish for our clients.
Yeah, the SEC actually is coming out with regs, or they implementing regs where you can point to third-party like rating services like Google, et cetera. As long as we don't have any control over them, they can we can not use the testimonials, but we could point to the situation because it's independent. And you know, at back-end benchmarking, we provide performance, so we've kind of provided some of that transparency of the advisors. I think one thing that's kind of interesting is one of the largest robos out there, Schwab, has pretty lousy performance, you know, which is not that good. And, you know, many of the robos have what I would call a bit underperformed benchmarks that seem somewhat reasonable. So, you know, we've caught different firms doing some weird things. SoFi was one of them, where we actually caught them putting money into their own ETF, causing taxable gains for people, and there was a settlement that was done. So, you know, I think offering this type of transparency is a good thing for the industry, and you know, we're going to fight further in this area. Hey, Dan, Betterment, do they provide any kind of performance? I think actually they do, or Wealthfront does. I think your competitor does. I don't think Betterment publishes performance, do they?
I mean, no, we absolutely do. We have both public pages.
Okay, you do. Okay,
yeah. On it. And I think one of the key things is that performance, it's tricky because people make a lot of mistakes with it. They misinterpret it. They don't know how to interpret how they should use it to inform decisions moving forward, rather than, you know, picking whichever team did really well last year. We do show clients performance of a portfolio that is both like what you're invested with us inside your account when you actually start investing, both time-weighted and money-weighted returns, as well as the benchmark that would be relevant. So, you know, somebody coming in and saying, well, I'm going to compare my income portfolio to the S&P 500, there's an obvious mismatch of expectations there in terms of performance.
Sure.
Like,
so you actually do publish performance of your track record, though, not just your individual account. You show like some track record. If I wanted to go on to your site and see how past Betterment clients have done, there's that information. I think Wealthfront does that. I'm not sure if Betterment does.
We have like our model portfolios. That is, this is the allocation at 90% stocks for our core portfolio. And it goes back, you know, it's back tested. Betterment started in like 2008. So there's live performance from then, and then there's model backtest going back prior to that.
Interesting. That's good. I commend you for that, for sure.
I think it's tricky because it can be used to inform people, but I get the impression most people don't use it in a responsible manner, such that I feel like putting any emphasis on pre-tax sort of like model performance figures. It reminds me of what like Fidelity used to do, where they would come out with 20 funds and they just had diverse strategies. And then like by the end of 5 or 6 years, one of them would have outperformed just because of sort of variance. And then they'd market that one. So if we're going to help consumers make good decisions about what to use moving forward, I don't think that historical performance numbers, unless they're put in a proper context, and we explain to them what mechanisms like cost or taxes contributed to that performance. Otherwise, we're just throwing noise at them and asking them to make a hard decision based upon randomness.
Look, past performance is no guarantee of future results, but it's definitely a start, right? It's a way to compare. It's a way to kind of sort things out. I think that it is an important aspect. I don't think it's the only aspect. You know, when we rank these things, we only count performance as like 40% or something of the ranking, for sure.
I mean, if you look at Morningstar's methodology when they compare funds, there's basically zero use of past performance. The one thing that matters most in predicting future performance about how a fund is going to do is going to be the cost and the turnover. So we do know things are predictive of future value, and it's not previous performance.
Yep, fees are the most important, for sure. But most people don't want to invest in a fund that did terrible the last 20 years. They don't want to take that chance, for sure. You know, no one buys a car that was, you know, a clunker for 10 years either and predicts now that it's going to go forward. You know, it is some indication of future performance, although it's not the best. You're absolutely correct. Fees are the number one predictor of future performance. You know, one question for you, Claire, is, you know, how do you think traditional advice firms should adapt in light of this kind of rapid adoption of robos? You know, we touched on that a little bit before.
And I can take the example of my parent company. So Rhinevest is owned by TruePoint Wealth Counsel, which has $3 billion in assets under management, is a traditional financial planning firm that started in the 90s and has client minimums of $3 million. And so TruePoint, seeing the changes happening in the industry, then it's 5 maybe. TruePoint then acquired Rhinevest as a solution to continue keeping up with all the changes that were happening in the industry.
Yeah, that's interesting. You know, Dan, a lot of robo-advisors, you know, they were raising a ton of money, and a lot of them were coming to market like 3-4 years ago, but not many new ones coming anymore. The most new ones actually are coming from the incumbent firms. Mainly, most people think it's because the fees are quite low and you need a lot of scale. What kind of scale do you think you need to actually, you know, come out with your own robo-advisor in the marketplace? Like, how much in assets do you think to be profitable?
As a new entrant or as an incumbent?
To enter it, for sure. I think as an incumbent, it's pretty easy. It's an arrow in the quiver, and you know, it's a great product to have. And why should your existing clients leave to go somewhere else? Clearly, the robo-advisor is a good thing to have. But I think, you know, if somebody new was going to get into the field like Betterment did in the past and like Wealthfront did, you know, how much in assets would they need?
I have no idea on the numbers. I'm not sort of on our finance team, but I can say, like, I would absolutely recommend that somebody does not do that. What seemed like a wide open space sort of 8 years ago, as you said, the incumbents are there. People are differentiating and looking at exactly what part of that market they want to serve. So I would only say a new entrant it's not really a matter of like the scale or the size, but rather they need to have some incredibly differentiating value feature that's going to bring them clients very quickly. And as you noted, there's sort of people at the low end like Acorns, people for older, more sort of near retirees like Vanguard. A new entrant would need to have some magic in order to make it happen.
Yeah. Do you think ESG is that magic? Do you think somebody could come up, you know, It's obviously attracted a bunch of assets. We've been testing it. The performance has been better. Jen, do you think ESG is, something that could, kind of create a wave in this industry at all?
Yeah, I mean, I do think ESG is becoming more and more popular now. And, with the way things are going. And so we offer, we just had a new ESG, like socially responsible portfolios come, like 13 different offerings. And so I think that's kind of helped us because we've gained a lot of popularity in that. So people just seem really interested in it. And we offer a new like impact dashboard that basically analyzes the portfolio and can kind of rate you based on, your values and morals and rate all your holdings. So you can kind of see like what you invest in your portfolio. So it kind of makes it easier for people to, navigate on, keeping different holdings or selling them based on their values. So I think it's a good tool.
Claire, in your practice, do you see the demand of ESG happening?
It slowly pop up. And thankfully, Betterment does have an ESG solution that we're able to put our clients into.
Yeah, and hey, Dan, on the theme of ESG, so when we look at these portfolios and we do some analysis, we don't, although they definitely have a bit of a higher ESG score than the traditional portfolios, we would expect the differences to be much greater, but really on like that scale that Sustainalytics uses, it's maybe 2 points difference, which seems pretty low. That scale has like 40 points of movement. So just doesn't seem that ESG like. What do you think about that? Do you think there's going to be more scrutiny in that area? What do you think?
One of the things that we actually have encountered and that has caused us to adapt exactly how we're doing this is that there's a real difference between somebody who wants a general ESG or SRI product and people who have very specific interests. And when we first launched our SRI product, we wanted to be able to sort of have it serve as many people as possible. It was a very broad impact thing, which means that it probably wasn't as targeted or forceful if you really cared about for-profit prisons and various other things. So one of I think the genuine open realm in ESG is how do we help people figure out, and I don't think that people know until they're asked in a sort of very guided, thoughtful way, what are the issues that you are willing to differentiate the portfolio that you're in on? And sometimes that's sort of short term. People generally think about whatever issues are in the news that day or recently. And you can end up with very different portfolios. So we now have not only the broad impact portfolio, but also a social impact one that is very much geared towards companies that are providing ladders in a social setting for people to climb up and do better in, and a climate one that's focused at fighting climate change. And what we found is that the money flowed out of the broad impact one and into the climate and social one, about half of it.
Interesting.
Really want
So on that note, I think that our time is up actually right now. Sorry to cut you off, Dan, but thank you very much for all your time today, Jen, Dan, and Claire, and enjoy the rest of your sessions for the day. And I think that's it.
Thank you very much.
Take care, everybody.
Thank you.